Thank you for coming. Perkins, Coie, I'll give you a little propaganda about our law firm first. That's always fun to do. We're a very large law firm with about 1,000 lawyers, 19 offices, 16 of which are in the States, 3 are in China. We have 2 offices in the Bay Area, one in San Francisco, one down here. And I in the firm head up our emerging company and venture capital practice. And it's a group of lawyers that spend most, if not all, of their time working with this odd species called the emerging company. And in our minds, what that is it's a company that's chasing a perishable market opportunity. It usually has something unique about it, or some unique asset that it thinks it can use in order to better exploit that market opportunity. It usually is not self-generated, so it needs external capital. And the commonality of those companies are that they move very quickly. They need to move quickly. As part of that practice, we also stay close to and help represent and support the investors in those companies, and that's why the venture capital side of it is critically important for us. We have about 475 venture capital-backed companies that use us as their general counsel. We have another several hundred that are not venture capital-backed, but heading on the same trajectory. And where we think our expertise really helps, where it's unique, is helping those very, very fast, rapidly growing companies manage their risk and see pitfalls and obstacles that they might not otherwise see. And we've had the good fortune of working with a lot of really interesting businesses along the way, founding counsels to companies like Box and Trulia and OpenTable and Cloudera and Cyanogen and a whole bunch of other interesting businesses. So enough of my propaganda, but we really love what we do, and we have a lot of really fun relationships that we have been fortunate enough to be affiliated with. My personal background, I am a Midwesterner. I grew up outside of Chicago. I went back east for undergrad, thought I was going to be a businessman, so I went to Wharton. Came back to the Midwest, married my high school sweetheart, went to law school at Illinois, settled down in Chicago and thought that was the center of the world. About a year later, my wife and I got a little claustrophobic in Chicago. Something about marrying your high school sweetheart, having all of your family nestled within a few blocks of one another. And she got a great opportunity with a company out here that had just gone public. And I was very early in my legal career questioning what I wanted to do, so I was willing to move anywhere. And so we came out to Silicon Valley for what we thought was going to be 2 years, and I've been here ever since 1993. And I have to say, I love it. And I can beat up Chicago better than anybody. But if any of you guys pick on it, I'm going to be defensive. So, I head up our practice here. My entire practice and my entire focus is on early stage startups. And I've been involved in hundreds, if not thousands, of financing transactions, hundreds, maybe not thousands, of M&A transactions, taking a bunch of companies public. I've done all that stuff. On the side of that daytime job, though, I do actually do some investing. I had the task of tabulating how many angel investments I've done over my career, and I was startled by how many it was. It exceeded 100. Most of them, admittedly, are my clients, but it's a lot of activity, and I've learned a little bit along the way. I also got roped into a deeper relationship with one of my entrepreneur friends about 3.5 years ago, and quasi co-founded a startup called Titan Aerospace, which we ended up selling to Google last spring. So I was able to not only counsel companies for 20 years, but then I started counseling myself, and I realized, hey, my counseling's not that bad, because it was a very successful outcome. So I'm going to come at this conversation from a number of different places, but by the way, it's supposed to be a very open dialogue. So if you have questions, blurt them out. We'll make sure that we touch on things that are most interesting to you. So let's jump in. How many, just to get started, how many of you are entrepreneurs? I met a bunch of you. I was working in a room in the back at the beginning. But how many of you are entrepreneurs? And of those, keep your hands up. How many of you have already raised capital? A few. So for those of you that have raised capital, I really do invite you to participate in the conversation. Of the others that put your hand down, how many are trying to raise capital or expect to be raising capital in the near future? Okay, so this should actually be somewhat relevant for you. We're going to talk about product engineering and we'll talk about funding. So let me get started here. This is a pretty obvious slide, but I like to set up the framework initially with what are the sources of capital? Right? I think Mr. Visa and Mr. MasterCard don't realize that they're probably the single highest contributors to seed capital in the country. It is not at all uncommon for us to see entrepreneurs come in and have racked up $5, $10, $15, $20,000 on their credit cards to just get started. They bought a Mac, they bought, I don't know, some supplies, maybe they're building something, so they have to buy some plastic, some molding, maybe they're developing software, they use off-the-shelf software to help them. Maybe they need a UI expert, so they hired a contractor for the wireframes of their PowerPoint, I don't know. But it's not at all uncommon. And I'd say that for many entrepreneurs that have the idea and think that they're going to get funded with the idea, your highest probability of capital or funding for that idea initially before it's anything other than an idea happens to be your credit card. I'm sorry to say it, but that's going to be the most accessible capital for you. Then you get into the FFFs, which is the friends, the fools, the family, not in any particular order, but that tends to be the folks that are willing to invest in the very earliest stage because they like the idea, but mostly they know you. They know who you are, and they're investing in who you are and your perseverance and your commitment to the project. Once you sort of get beyond that, the non-familial sources of capital, the stuff that's not within your control, so to speak, are the angels, the super angels, and the seed funds. And this is kind of a blurry category. It used to be really black and white. There was angels, and then there was VCs. And over the last decade or so, we've seen the emergence of super angels and seed funds. I mean, you can't be a popular kid in Palo Alto unless you have your own seed fund these days. There's literally hundreds. But just to give some definition about how I think of this, to me, angels are people that make angel investments. They don't do it as a profession. They do it on the side of their daytime job. Oftentimes, the angel investments they're making are their friends or in a domain that they're a deep expert in and it came to their attention. Maybe they're advising the company in addition to providing some advice, they threw some capital. Super angels are a little different species. Super angels, to me, are professional seed investors. They're people that have now made this their full-time job, or if it's not their full-time job, it's darn close to it. The most noteworthy is Ron Conway, super angel extraordinary. You guys can Google him. He's invested in literally hundreds of startups. It's his job, and there's a whole bunch of them. And then some of them actually proceed to not only invest their own money, but they raise a pool of capital. And usually it's a fund of $5 million up to maybe $100 million. And it's earmarked to make investments, to be the first institutional investor in a startup. Usually the amount is $250,000, maybe up to $500,000 per investment. And it's out of a fund, and those are the seed funds. And there is lists upon lists of them. In fact, before I came here, I was just doing a quick Google because somebody's name had come up and they said they had left a large firm to start another seed fund. And so I did a Google search on Google, new seed funds in Silicon Valley, and it's just like, big list. So the next bullet here is crowdfunding. And in my mind, there's sort of two types of crowdfunding. One that has proven to be very effective for a product, and that is the Kickstarters, the Indiegos, the funding platforms that are not actually there to create investment in your company for equity, but instead to pre-buy, so to speak, a product. And they have varying degrees of efficacy, but there have been very successful crowdfunded raises through those platforms for the right kind of product. Something that us lawyers are still not entirely comfortable with. It's the platforms that are trying to crowdsource seed investments in exchange for equity. And the reason why us lawyers aren't terribly comfortable with that yet is because the regulatory framework around that is not well defined. It's not really supportive yet of that. Securities laws in the United States are not paternalistic, so to speak, but they really do have at least some purpose of protecting people that don't necessarily have a high net worth. And so the danger with these crowdfunding platforms that are equity-based is that those individuals may actually not be of a financial net worth that supports them investing in very speculative startups. The next bullet down is venture capital. We're going to delve a little bit deeper into it, but I think it's what we all, living around here, hear about day in and day out. It is truly an industry now, and I'll give some statistics on where it's been and where it's going. But when I first started doing what I'm doing in the early 90s, venture capital it existed, but it was a cottage industry. It was kind of a club. There was maybe $4 to $6 billion annually of money that came out of venture funds into startups. By 2001, it was about $110 billion. And this last year, about $48 billion was invested by venture capital funds into startup companies in the United States. So it's a real animal. And we're going to talk about the dynamics there and when companies are eligible to raise venture capital, what venture capitalists are looking for in here. Corporate, we see, it's interesting, there's always corporate investments, but it does ebb and flow. And one might argue that when corporate venture investing hits its peak, sell everything you have because the market's about to crash. There is a high correlation. Corporate venture investing or corporate startup investing ranges from very organized investing like Intel Capital, which is the world's largest and most active venture capital investor, to corporations that opportunistically make investments in startups because they see something on the frontier that they may not be able to justify developing internally, but they want to have a placeholder. If you would have gone to Hertz Rent-A-Car in 2009 and said, hey, got a great startup for you. You can put $1 million in it, own a significant interest. And by the way, it's gonna change your industry. And it's called Uber. Do you think Hertz Rent-A-Car would have done that? Should they have done that? Yes. Or if you went to, I don't know, Marriott or Starwood and you said, you know what, there's another startup, there's a startup coming, it's gonna revolutionize the hospitality industry. Excuse me. And for $1 million, you can sort of own a very influencing position there. It's called Airbnb. Would they have done it? Should they have done it? We're in a pretty interesting time right now where these very, very large industries are being reinvented or being challenged in a dramatic way very, very quickly. So corporations are not fools. And many of them recognize there are some opportunities. And maybe Hertz could not have started Uber on its own. In fact, I'm pretty convinced they could not have done that. But somebody outside of Hertz could have, and they did. And Hertz could have had a little piece of that, a little visibility into it. So I think of it as pioneering, almost for corporate investors. And we see that happening. I think corporate investment last year was a record high, or at least a high that approximated the last high, which was in 2000. About $8 billion of corporate venture investment is made in the United States. Governments and grants, I'm not going to talk a ton about this because we frankly don't see a lot of it. And we don't necessarily see our entrepreneurs pursuing much of it. But the concept here is that on occasion the government, federal, state, municipalities have incentives to catalyze business. Maybe it's tax incentives. Maybe it's specific industry incentives. When Cleantech really sort of hit its first crest 5 or 6 years ago, there was a number of interesting grants and loan programs available from the Department of Energy and the Department of Defense. And a number of companies took advantage, and the Department of Transportation. And a number of companies took advantage of that. We've seen some of the aftermath on that. But don't count it out. Particularly in hard science, there tends to be some very interesting funding, non-dilutive funding opportunities with the government. And if any of you are working on anything in the hard sciences, I'd be happy to talk about it offline, as with, I'm sure, some of my partners here. The last category is what I'll call the opportunistic investors. On occasion, we'll see public investors like T. Rowe or Fidelity or Vanguard, or we'll see private equity investors or hedge funds come into the venture market, come into the early stage investing market. Again, that might be a signal that we're getting towards the top of the market because they tend to do it in the later rounds. Well, I'll just leave it at that. Any questions with this? Yeah.
What's the difference between seed funds and VC? Is it the size of the pool?
Yeah, it's a great question. I don't know if there's a really sharp distinction between the two. I think part of it's influenced by the size of the pool and whether they've actually developed an institutional brand. I mean, many of these seed funds that are sprouting up now have the intention to eventually become a venture capital firm. You know, they'll raise one fund, they'll do really well, then they'll raise a second fund that's bigger, they'll do well in that, then all of a sudden, they do have $400 million under management, they're a real fund.
So there's no difference in securities laws between...
No difference in securities laws. Maybe a little different orientation in terms of flexibility on investing, but it's really smaller, bigger, I think is what we're seeing. Any other questions with this slide? So let's dig in a little bit. I mentioned the statistics in the venture capital industry, and the venture capital industry is the one that's tracked the best. It's the one where we have the best data. But as I mentioned, in the early 90s, it was a cottage industry. There was, less than 50 venture funds making investments. They oftentimes collaborated with one another. It's a fun book. I won't call it good literature, but The Valley Boy by Tom Perkins is a nice read, a couple-day read. It talks about the early days of venture capital at Coie or Perkins. I'm sure he's probably mortified with the recent stuff there, but it really was a kind of a small industry. A lot of the ideas were nurtured at the funds, and then spun out. And one of the stories in Tom's book is about digital equipment, how it got off the ground. And by 2000, a few of you are old enough to remember that, the market really heated up and venture capital really expanded dramatically. It was, in the venture capital industry, there's sort of 4 statistics that are very carefully tracked. How much money has been committed to new funds in a particular year? How much money those venture funds have invested in startups? How many startups received venture funding? And then geographically where that money has been dispersed. In 2000, as I mentioned earlier, there was $110 billion invested into startups. There was similarly about $100 billion that was raised by venture funds in 2000. And then we all know what kind of happened after that. It really sort of cratered down. And it really, the interesting thing about venture capital funds, when you raise a venture fund, and say you raise a $400 million venture fund, you don't actually take $400 million and put it in your bank account as a venture fund. You get commitments from your limited partners that they will fund into your fund $400 million over time. And your job as the venture capitalist is to find opportunities and then call a portion of that capital before you put it into the company. Does anybody know why there's a delay? Why they don't just take all $400 million and hold on to it? Why they let the investors hold it in their hands until they're ready to invest it?
Interest. I said interest.
Time value of money?
You're all right, because I'm having trouble with suffering out of the conversation. They get graded on how much they return over a specific period of time. So they don't want to touch the money until they're ready to put it at work. So when you raise a $400 million fund, you don't actually hold $400 million. You have commitments to fund $400 million over roughly a 10-year period. And sometimes you actually don't take all of that $400 million. Sometimes you only take 300 of it. But in any event, after the crash in 2000, the venture industry really went through a pretty swift decline. So that around 2005, it hovered around an $18 to $20 billion capital formation per year level. And then, as I mentioned, last year popped slowly. It's been gradually popping up. So last year, the amount of money put into companies was $48 billion, and the amount of money gathered into new funds was about $28 billion. So healthy level right now. I won't tell you how I derive the number per se offline. If people are interested, I can tell you it. But we looked at how many companies were formed in Delaware, which is the preponderance of where these kinds of companies get formed. And we hypothecated on how much seed capital a funded startup gets, which is about $1 million on average. Sometimes it's 3, sometimes it's 500 grand. And we put a percentage on the number of companies that we think actually were able to close on capital based upon noise that we hear in the market. And that's kind of where we came up with the statistic. But that's a pretty darn significant amount of capital going into early stage. The other interesting thing to note is while the venture capital industry has started to resume in terms of capital formation, this number is still lower than the number of funds that raised capital 10 years ago. And if you actually sort of segment out the capital, you'll see there's an 80-20 rule where 20% of these funds sort of are responsible for raising about 80 or 90% of this money. And I mention this because what we're seeing is the dumbbell effect. What many of us, of my vintage, not of your vintage, remember as a Series A financing, the first financing for a venture fund, is really no longer the type of round that most venture capitalists prioritize. The first round of capital is no longer coming necessarily from venture capital. It's coming from those other categories, the angels, the super angels, and the seeds. Instead, venture capital is a little later stage. What we used to think about as a Series B is really now a Series A. The company has a product, it's in market, they've got early customers, those customers are referenceable, and those customers seem to be very replicable. Then you're eligible for venture capital. I'm going to say that again because I think many of you will want to remember this. You become eligible to raise venture capital when you have a product in market. What did I just say? Product in market. You have customers. They are referenceable, and they are replicable. You need the big market, you need a good team, you need all those other factors too that we'll talk about later, but I wanted to get that out. So what is the process? For those of you that are going to go out and raise some capital, the first step is to prepare. And this is an ongoing process. You will never complete your preparation for raising capital, but you have to start somewhere. The first place you start is by building your executive summary. It's an incredibly painful document. How many people in here have actually authored, an executive summary? Yeah, and how many of you took less than an hour to build that? How many of you took more than 100 hours to build that? Yeah, that's more like it. Not to be sort of self-promoting, although I will be. I wrote a blog about executive summary drafting. You can check it out on my blog if you want. I like it. I think it's accurate. Having written many of these myself, I finally found it painful to not have a checklist. So, yeah.
The executive summary is a one-pager?
Well, one page, it's a short document is the way I'll respond. It's a short document that really synthesizes the most important aspects and most attractive aspects about the investment opportunity. It's not intended to be a business plan. It's not going to exhaustively describe your business. But it's enough to get a prospective reader to want to sit down with you and hear more. You also need to develop your deck, which is actually an equally painful process. And I did not write a blog on how to do that. But the general idea is it's a visual description of your business. 12 to 15 slides is the target. You should be able to walk through it in 15 to 20 minutes. And you really want to prioritize the same categories of information that you prioritized when you drafted your executive summary. And I won't list them all now, but I'm happy to point you to my blog later if it's on there. And the last thing, or maybe not the last thing, but another thing that you need to prepare is a financial model. And we get a ton of questions as early stage advisors to our clients. What does that have to show? What should I be showing there? What kind of revenue growth is important? And the answer is, we can't really tell you, nobody can tell you what the right revenue growth is. You have to look at your business, and you have to figure it out yourself. What's realistic, and how did you build that model? And as an angel investor, I will tell you that it's mildly interesting to see your revenue projections, but I don't take them too seriously. I don't think many investors take them too seriously. More important to me is I want to see the expense side of it. I want to know what you're doing with the seed capital that you're being given. I want to know how you're going to spend it, and frankly, at the end of the spend, I want to know what you're going to get out of it. What are the major milestones that you're achieving with that money? Because the hope is that it's enough milestones to make you eligible to raise the next round of capital at a higher, hopefully a very high, valuation. So these are the sort of the minimum collateral I would say that you need to prepare as you head into a fundraising process. The next thing you need to, question.
I appreciate the comment you just made that you as an angel are interested in expense, because that's kind of true. But I, as an entrepreneur, need to understand what is my revenue model to validate, is this a profitable venture for me? Mm-hmm. So even if you don't take it seriously, if I'm honest with myself, I need to know at least to outline what I want in my executive summary.
Right. I think one of the things I think makes writing an executive summary so difficult is that exact exercise. It's the sober look at this business opportunity and whether it actually can achieve the revenue and ultimately income potential that's going to be exciting to me, my investors, my employees, the people that I bring into that project. And it's hard to do that. I mean, I take, there's the common two approaches towards revenue development. One is the bottoms up, units, timing to market, cost of sales, sales cycle, et cetera, to sort of build a bottom up model. And the other is the tops down. Here's the TAM. What's a realistic, amount of the TAM that I should be able to capitalize on in year one? What are the resources I need to do that? But that project, that effort, is probably the hardest thing to do when you're building your executive summary. Because you can't really build an executive summary until you have a great sense of how big this business can grow into and how you're going to grow it.
But would you want to, even though I understand why you said the expenses are important because that's how you're thinking, wouldn't you want to know that the entrepreneur at least thought about it?
Sure,
even
sure.
if you just yeah.
No, I didn't mean to dismiss it completely. I would absolutely like to see your revenue projections, and more importantly, I'd like to see how you got to them, because that'll help me understand how you're thinking about the opportunity. And if it's not a market I know well, it'll also educate me on the market. Yeah.
So I'm wondering where the business plan fits in on all this.
So I think the business plan is a very personal thing. To me, a business plan, as an investor, I don't want to read it. I won't read it. I don't have time to read it. But I'm awfully comforted by knowing that the entrepreneur has a business plan. And to me, the business plan is hopefully a living document for you, something that you constantly revisit. So to me, a business plan is actually the precursor to this. I may be unique in that thought. I don't think I am, but I'm comforted to know that an entrepreneur has a business plan. I'm hoping that entrepreneur uses that as a tool to continue to iterate on their plans and their prioritization. And I believe firmly that that's a precursor to all of this. There was another question? Yeah.
Financial model, pick what kind that you like to see at this stage?
On the expense side, I'm a fan of detail because it shows me that you've really thought through how much does it cost to hire this engineer at this level? Where am I going to house everybody? How much is that going to cost? What are things as silly as the utilities that I need? How many computers? What kind of software? All those details are actually pretty interesting. I probably don't want it the very first time you send over my executive summary.
Yeah.
But when we sit down and really understand and get to know each other, yeah, I would dig into that. I really want to know where the dollars are being spent. I want to know if they're realistic. And when I'm reviewing them, there's two things in my mind. Is this entrepreneur out to lunch, or are they really, have they given it a lot of thought? And second, is just enough money? Because the worst thing as a seed investor is to participate in a round that's not enough. It doesn't give the company enough runway. Yeah.
So what's the time period you should put for the expenses? Like just for 3 months, 6 months, a year?
Well, it would be unusual to raise a seed round that doesn't fuel you for long enough to hit the major milestones that are necessary to hit in order to be eligible to raise that next round. So, if you showed me an expense waterfall of 3 to 6 months, I'd sort of scratch my head and say, well, I'm not funding you for 3 to 6 months. This round should not only fund you for 3 to 6 months. That's not enough time. It's going to take you 3 to 6 months to raise your next round, so you need a lot more time than that. So I look at, what's realistic. How much are you raising? How long is it going to take to burn through that capital? What do you get for those milestones? And if it's a year, 2 years, that's kind of the norm.
What's the outline for the deck?
The outline for the deck. I haven't written that. Maybe I should. But I think if you think about what are the important points of this business, and I can rattle some off right now if that's helpful. I think you need to have an overview of the business, an industry overview. You need to describe your solution. You need to sort of describe your strategy. You probably need to describe the competitive landscape. You might want to talk about your technology, if that's a unique attribute, and that might include some of the technology resources that you're bringing into it. You might have enough visibility into your sales and marketing efforts, at least your go-to-market, your initial sales and marketing efforts, to be able to describe that. And then I'd want to see the team. I'd want to know about the team and then the finances. So that would be kind of the way I'd structure it. Yeah.
I have a question about this executive summary. When you see it for the first time as an investor, what should be on it? Because the stuff you just rattled off, I was on one teleconference, and the angel investor said he wanted to see all that on a one pager, and that's kind of hard to do.
Yeah. Angel investors are weird. And they all have their own. I mean, I've been doing this for 23 years, and they all have their own biases. I think the commonality is everybody has a short attention span. They're good, but they're busy, they don't have a lot of time. And so you're trying to get at least enough message, enough of the excitement about your opportunity across in a short period of time to then catalyze that second meeting, the more in-depth get together. So some investors are like, look, I just want a paragraph. Tell me what you're doing. If it strikes a chord with me, I'll invite you in to meet. If it doesn't, I'm on to my next deal. And some investors, see literally dozens of things a game. Our team, and we're lawyers, we're not the investors per se. We probably get shown, 35 to 50 new deals a week, startups. So it's a lot of volume. And so, you figure you got a minute or two of somebody's attention to capture their excitement. And that may mean a one-page summary, maybe a one paragraph, and maybe 2 pages. But you want to use whatever real estate you think is appropriate in the most effective manner, and that's to capture the excitement quickly. And one way to do that is to know the audience, know your investor. Where has he or she invested before? What kind of things are likely to resonate with them? And get that up early in the documents so they can see it. All right. Yeah.
So what I'm hearing you say is that you have to research your investor and maybe have an executive summary that's key for each investor as opposed to having one executive summary.
Yes and no. I mean, I think it would be unreasonable to have customized executive summaries. That would drive me crazy. And I don't think it's fair for an entrepreneur to have to do that. But researching your investors is an awesome segue. Is critical. It's a critical step in fundraising. So, use that as a segue to get to the second part of the slide, planning out the meetings. The first thing you need to know is who are the audiences that are likely to fund something at the stage that you're at and in the sector that you're pursuing, and with the resources that you've already accumulated around the business. If you are a first-time entrepreneur and you're doing you're discovering a new drug, you have an idea for how to discover a new drug, don't go talk to Andreessen Horowitz. Don't waste your time. They don't invest in drug discovery, and they're probably not going to do something at this stage. The probability of them doing something at a seed stage with somebody that they've never worked with before is 0. So don't waste your time with that. So you got to know the types of investors that you're stage appropriate and sector appropriate to sort of present to. When you sort of start with that, when you call that list, and let's call it the angels or the seed funds, then you start just putting as many of them on the list as you can, and then you start researching them. Where have they invested? Oh, they're consumer only, like Maven Ventures? Well, I'm an enterprise play, so I can't go talk to Maven. They're U.S. only, and I'm based, or they're West Coast only, and I'm based in Denver. I guess I shouldn't be, pursuing that. So you look at the stage you're at, and you come up with a list of folks that are stage appropriate. You look at sector, the sector you're in. You look at the investors on that list that are sectors appropriate. You look at geography. You look at the stage of investments. You look at their portfolio to see if they have anything competitive, because that's something very few investors will do, which is invest in competitive opportunities. And then last is you look at those funds and you figure out, do you have a unique access point to them? I'm sure all of you have heard professional investors say that they are very unresponsive to cold calls. They are. They just are. There's too many deals that are thrown at them from their network, from people they know. They don't necessarily take the cold calls seriously. There's an exception to the rule. Log Logic, which was funded by Sequoia Capital, was a cold call to Sequoia. It ended up being a fantastic investment. But in my 23 years of doing this, I can only point to 2 or 3 examples like that. You really want to sort of have a connection point to a prospective investor, a warm introduction. And how do you find those warm introductions? Well, part of the exercise of finding warm introductions or immersing yourself into the community is your resourcefulness for getting into the community. It's using the right advisors. It's finding the right technical advisors. It's finding the right connections at the university. It's finding the right law firm. It's working to find the right people and getting them excited about what you're doing. They're a screen to your sales page. And by the way, LinkedIn is a phenomenal tool. And I am a stockholder, so I am promoting it a little bit, but it is a phenomenal tool for finding access points to prospective investors. Once you start the pitching process, and I can talk a little bit about that process in a few if it's of interest to folks or even offline, you should expect diligence. There are stories of investors that love what you say and cut you a check on the spot. There's not many of those that happen. I shared a story earlier with Rob about an entrepreneur that I had worked with on 2 prior companies. Both have been successful. He came to me up with his third, and he said, I have a new company. I said, how much? I didn't wait, because I know him, and no matter what he does, I'm going to back him. But that's somebody I've known for years and I've had successes with. So expect diligence. In fact, the best investors are careful. And what does that mean? As a lawyer, I have a bias towards clean documentation. It doesn't have to be perfect, but it has to be clean. And I can talk a little bit more in detail about what that means. But this next point I think is the most important. In the early stages, before there's really proof in the market that what you're doing is just killer, it's about you as an individual. The bet is on you. And the best way to learn or to confirm whether you're the right person to bet on is references. And they can be references that you as an entrepreneur offer up to the prospective investor, or it could be blind references. And so think about, in your mind, where you've worked and who you've run across and who might be somewhat visible and what kind of impression they have of you. Anticipate the negative, hopefully steer around it. Anticipate the positive and hopefully steer toward it. But references are absolutely critical. I never have made an investment without the reference.
So you don't take much stocks in the reference, in the names and numbers given by the.
I do. I think most investors do. I mean, I'm saying I as if I'm like this big investor. I'm not. Yes, I think investors take both very seriously. I mean, a canned reference, a reference that's catalyzed for me, is important because I want to know why interestingly, I've been aware of canned references that actually have been very negative. And the entrepreneur didn't know that. It's, call my boss at Cisco. It'll tell you all these great things. And then the investor calls and is like, no, stay away. And so shame on the investor. Frankly, the investor should have known better. I mean, the entrepreneur should have known better. But I will call that person. And there's usually some very interesting things I can learn about it. First, I can corroborate the entrepreneur's history. Because entrepreneurs, when they tell about their own story, it's always the good. You don't usually tell the bad. And so when you talk to somebody that worked around that person, even if they're a huge fan, they might tell you some of the challenges and get a little sense of the grit. So I think they're both important.
What do you mean exactly by clean documentation as opposed to perfect?
So maybe that was a little better. Clean documentation to me means that you've thought about and crafted your organization the right way. So if you're planning at some point to raise this kind of capital, that kind of capital, I would expect you to be a Delaware C corporation. And I would actually expect you to be formed already. I would expect the ownership among the founding team to already have been dealt with. I would have expected you to be sort of thoughtful about vesting on the founders in anticipation that you're going to raise outside capital. I would expect to be able to access those documents quickly and see them. I would expect the materials you provide me for diligence, whether it's your executive summary or your deck or a reference sheet, to be accurate, has the right telephone number. That's what I mean by clean. I want to know you're a professional. And if you're not doing the documentation yourself, which you probably are not, you're hiring somebody else to do it, the person that you've hired should be a professional too. They reflect your persona. So if you use somebody that doesn't know what they're doing and they put together a sloppy formation paperwork, that's a warning sign for me. I don't like that. Again, I'm probably more biased about that as a lawyer, but that's what I mean by clean documentation. Question to that.
What do you mean by vesting of the founder?
I can't hear.
You mentioned vesting of the founder.
Vesting of the founder.
Yeah.
So maybe a longer conversation we can take offline, but I believe, that having lived through a number of hard experiences, that when there's more than one founder, the founder should self-impose vesting upon themselves. And it should be structured in a way that's expecting institutional investors at some point to come into the company and expect that vesting to already exist. So I can talk to you offline about what that means more detail. Any other questions before I move on? In these early stage rounds, when you're raising your first round of, yeah.
How much of you investing with an individual has to do with that personality and value fit, as much as the space and the industry and the money numbers?
Hard to say. Did everybody hear the question? How much of it is about the person versus the market size? Right, is that what the question was? Yeah, I think every investor I think investors will tell you there's really three things that influence the investment. They all have to be there. It's got to be a big market opportunity. The timing has to be right. It has to be the right person or the right team. And they have to, have something unique about what they're building to give them confidence that they're going to be able to capitalize on that market. So I don't think it's an either or. I think people are very, very important at this stage. I think it's probably the most important, but it can't come in isolation. It has to come with the other two characteristics. So when you're raising your first round of capital, what are investors looking at? What are they looking for? And so I threw this up here because I think it's a good exercise for any entrepreneur to go through. What is your hypothesis? I mean, you haven't proven it. Otherwise, you wouldn't be fundraising. You'd already be generating income and you'd be off to the races. So what is your hypothesis? And what are the assumptions upon which you've made that hypothesis? And how far along are you in terms of testing that hypothesis? And what's the time frame for finishing that test? I think if you think about conveying that to a prospective investor succinctly, I think you'll have great success getting them to at least understand and appreciate what you're doing. They might not necessarily agree with your hypothesis, but when they do, all the other questions around timing, resource needs, will fall in line. So critical to be able to communicate your hypothesis or your hypotheses. And I've got MVP here, which is an acronym for minimum viable product. I had a couple entrepreneurs come in this morning that we've been working with for about 60 days. And I truly believe they have a great idea, and I think they see a market opportunity. But they've been digging so hard for the last 60 days on the back end, the stuff that nobody really sees, but ultimately when their final product is launched, it will be an important part of that product. But because they haven't been spending any time with the customer, with the user of their solution or their future solution, they don't have great insights into exactly how it's going to be used and what kind of value the customer is going to get out of it. So the conversation this morning was, it's wonderful that you spent 60 days building this incredibly powerful backend, but you haven't talked to a customer for 60 days. And no investor is going to get comfortable that you know what you're doing until you get customer feedback on your idea or maybe your features. So build some wireframes, can the solution, and see if that resonates with somebody. So what do investors look for? They look for the market opportunity, they look for the people, and they look for what's going to make you the unique thing, whether it's a product or a hypothesis. On the team, it's mostly about the founders, but who you associate yourself with will also influence an investor's perspective on the opportunity. Many startups develop advisors, maybe even formalize an advisory board. And the quality of the people that you're bringing into that advisor network does portray you and does sort of reflect who you are. Same with your service providers. Again, I'm a lawyer, so I'm going to be biased about this, but I think it does have some influence. Timing, yeah.
For early employees, not founders. So for founders, I kind of understand how you kind of split the pie. It's pretty obvious. Early employees, I'm not so sure what you do with them and how does it look to investors based on business decisions.
If the question is how do you provide equity to the early employees, is that the question? There's some formulas, and maybe I can talk to you offline a little bit about it. I think there's sort of a way to triangulate on what's the right level for people, and I'm happy to share with you the three methodologies that help you triangulate.
Thank you.
But from a timing standpoint, how long does this process really take? Well, assuming that you've done all the preparatory work, and assuming that you've sort of laid out, who are the likely sources of capital, and you figured out a path to them. That's either personal or 1 degree of separation away or 2 degrees of separation away. And assuming that you can speak very succinctly about your hypothesis, and you've got the complexion of a team that's ready to rock and roll and they already do after you know it. A seed round usually takes about 90 to 120 days to raise if you're successful at it. And it certainly can take longer. And it has taken shorter. But a successful raise usually comes together in about 90 to 120 days. The process, and that's from the time you start to the time you get commitments. It takes another 2 to 4 weeks to actually close the legal process. But manage your expectations accordingly. If your expectations are much quicker than that, I'm afraid you're going to be disappointed, or you might be very lucky, I don't know. But that's usually the timing.
Are we talking about VC?
No, raising your angel round. Or your seed round, I'm sorry, raising your first round of capital. And the expectations are, we took a look at I think it was 117 seed deals we did last year in terms of valuation and proceeds. The proceeds averaged a little shy of $1 million, so there were plenty that were above $1 million. There were a handful that were below. And the valuations, and I'm going to talk about valuations in a moment, ranged about $3.5 million. 3 to 3.5 million.
You talked about customer discovery, right? If you're pre-revenue, what's a good model to show a potential investor that you've done your research and you've done your customer discovery so that they'll be more comfortable knowing that you're niche in the market?
I think it's if it's an enterprise thing, having a reference at a handful of enterprises that you've talked to about the solution, that you sort of helped conjure in their mind, what you're building and how it would integrate into their system and what kind of solution or value they'll get out of it, and enabling them to talk about that with prospective investors, that can be very helpful. From the consumer standpoint, it's super hard. That's why raising seed capital for a consumer-oriented, consumer-facing product is really hard until you actually have consumer traction.
What about focus groups for him?
Focus groups, that's a great idea. I think you can bring people in and show them wireframes and get their reaction to it and have people, what investors are looking for is that replicable experience. And it's got to be genuine. So it can't be your friends. It can't be the bluebird sales that you knocked down early in your sales life, because those aren't really replicable. So you're trying to sort of gather information that would give a prospective investor the sense that this is a replicable perspective on what you've built.
Wouldn't things like Kickstarter give you a reference point to do more? Something like buy?
Yeah, I think Kickstarter might. I don't think it's conclusive. I think a good Kickstarter campaign means that you're you've really articulated well to that particular audience a product that they want to pre-buy. And so that does demonstrate some interesting marketing prowess and messaging prowess. But I don't think it's conclusive. It's one of many. So let me talk a little bit about funding structures. I don't know if we have time to go into too much detail here, and I'm happy to talk offline about this, but these seed rounds come together, when they finally do come together, they tend to be structured either as debt or equity. And then there's something in the middle that has emerged in large part because of one of my partners, Lowell Ness, conjured up this idea called a SAFE that was adopted by Y Combinator. But in my mind, as I'll mention in a few moments, as I'll describe in a few moments, SAFE is really kind of the same thing as debt. So when the investors are ready to make an investment, they either make it in the form of equity or debt. As an angel investor, I'll tell you I don't really care which way it's structured. In fact, I almost prefer for a small round, under $1 million, that you do it as debt because the costs of that transaction, the amount of paperwork that needs to be produced is a lot thinner than on an equity deal. Which I'm going to explain in a moment. But before I get to that differentiation, in any of these investments, there's essentially 4 categories of terms that get talked about, get negotiated, and in an equity financing get papered. The first are the economic terms. The second are the control terms. The third are rights to information about the startup. And the fourth is how do I get my money out? On occasion, there'll be some additional customized terms, but I'm not going to delve too deeply here because it's really not the norm. So what do I mean by economic terms? By far the most important conversation in an early stage financing is the valuation. What is the valuation of the business that I'm about to give money to? And the vernacular that we talk about is the pre-money. What's the pre-money or the pre-investment valuation? What is the valuation of the business before my money goes into it? Part and parcel to valuation, though, is this concept of a pool. Does anybody know what a pool means? What do I mean when I say that it was a pool?
Several sources of funding?
No. It's a chunk of stock that I want to set aside, unallocated, that you're going to use to issue to employees in the future. And the reason why it's part and parcel with price is because oftentimes these investments are structured in a way that says, I'll give you a $4 million valuation. I'll agree that the value of the company is worth $4 million. I'm going to give you $1 million, which means after my $1 million goes in, the enterprise will give you $5 million. But I want a 20% pool, and I don't want it to dilute me. For my $1 million, I want 20% of the company, and I want another 20% set aside for the pool. So what does that mean the value of the businesses? Is it really $4 million? No, it's really $3 million, right? And that math I can kind of run you through offline if you didn't follow it. But that's really how evaluation works. And it's by far the most important. The second economic term, maybe not the second most important, but nevertheless something that's important to me as an early stage investor is proceeds. How much are you raising total? What's the size of the round? And what does it get you? How long does that take you? How many milestones? What are the milestones you're going to hit when you consume that capital? The proceeds. What are the proceeds? Is there any big debt that you've already accrued that you need to extinguish when you raise my capital? If so, I want to know about that. I would be really unhappy if I invested $1 million and immediately 500,000 went out the door to pay for your past sins, especially if I didn't know about that. So, what's the proceeds and what are you using it for? What are you using it for? Third issue up here is liquidation preference. This is the most important legal economic term. And what it does is it dictates how the proceeds in the sale of the company, assuming that sale happens before an IPO, are distributed to the stockholders. And there's a whole bunch of interesting formulas that we lawyers have created to define liquidation preference. But in the early stage rounds, it's very rarely anything other than what's called non-participating preferred. And what non-participating preferred does is it gives the investors some downside protection, but on the upside they share, the same way that a common stockholder would share. So the more formal, the more descriptive way of summarizing that for you is, I as an investor, I typically buy preferred stock. My liquidation preference will say that when there's a sale of the company, I either get my money back or I convert into common and share alongside the common. And that's how the vast majority of liquidation preferences for this stage of business are structured. Anti-dilution protection, another economic term. This basically gives me some protection if you turn around and sell stock at a price per share lower than I bought. And there's different formulations and adjustment mechanisms that us lawyers have created to sort of reveal this protection. But In the early stage, it's pretty standard, broad-based weighted average. Dividend preference, most of these businesses never expect to pay dividends, even when they're big mature companies. So we lawyers don't get too worked up about the dividend preference, as long as it's structured as a when, as, and if dividend, instead of what's called accumulating dividend. We're never expecting, we don't want to have the obligation, but we'll put it there just in case. And the only time in my 23 years of working with literally 1,000 startups that I've seen a dividend preference activated was when a company that we worked with for 6 or 7 years had built a decent business, but it wasn't able to go public. It tried to sell itself, couldn't sell itself, was kind of just humming along, generating a little bit of cash, and the investors used the dividend preference to get some of their money back. And ultimately, when they demanded that the management team got new vigor to sell the company, they just sold the company. Preemptive rights, anybody know what preemptive rights are? They're super important for an investor, at least in my mind they are. They give the investor the right to participate in future sales of equity by the company in order to maintain their ownership percentage. Preemptive right, also known sometimes as a right of first refusal. So those are the economic terms. The next are the control terms. And in an early stage business like the ones we've been talking about, where there's maybe not even a product in market of this, it's very early, there's maybe not a lot of people involved, there's the founders and maybe a handful of other key employees. You know, control is kind of almost a theoretical thing. Control is in many entrepreneurs, before they sort of get into the legalities of how the organization is managed and controlled, think that control is as simple as majority ownership. And it's not. There's a whole myriad of ways that you can influence the control of the business. It might be who controls, what vote is needed to sell the business? What vote is needed to expand the size of the board? What vote is needed to go and raise additional capital? What vote is needed to declare a dividend? What vote is needed to buy back stock from the departing founder or departing employee? What vote is needed to borrow money? There's a whole bunch of important things that the company is likely to do in the future. And the question is, whose vote is needed to get that stuff done? And so in these early stage financings, control doesn't necessarily get that granular, because a lot of investors take this perspective that it's kind of a binary outcome. Either the money's going to go in and the company's going to be successful enough to raise the next round of capital, or it's not. And there's not a lot in between. But when control does get talked about in structure, the first thing that's looked at is the board composition. How many board members are there, and how many of those board members represent the investors? And I will tell you, in these seed rounds that we do, very rarely do the investors take control of the board. Very rarely do they have more than half the board members appointed. However, similarly, very few of these companies ever do something without all of the board agreeing. In my 23 years of practice, I probably can count on one hand how many major decisions were made by my companies that did not have unanimous board approval. So this is an important term, but it's not one that we get highly allergic to in the early days. Protective provisions are actually, yeah.
Should you have constructed a board before you go out for your?
Well, if you formed your company, technically you have to have a board of directors. So if you've actually formed the entity, which you should definitely do before you raise capital,
Right.
then you actually have to have a board by law. It can be you and your founder, it can be just you, but it should exist.
I'm an LLC, so maybe I.
Well, you should have managing members, you should have a board, it's important.
Do you typically find companies amending their articles of incorporation for a Delaware C Corp prior to funding?
No, the stuff, most of the stuff gets codified in the articles of incorporation. So the articles will be amended the moment you're closing that financing, and leading up to that, you're negotiating these points. Protective provisions, by the way, are one of those things that get included into the charter document, the articles of incorporation, the thing that gets filed with the Secretary of State's office. And these are usually limited. These are the vetoes that I just went through. They're vetoes. You need the holders of the majority of the preferred stock to approve the sale of the company. really important votes that are controlled by the class of stock that you're selling are usually codified in the charter and they're filed with the Secretary of State's office. And then similarly, there's another set of vetoes or covenants, so to speak, that a company oftentimes will agree to. They're not quite as important as what gets put in the charter, but nevertheless are negotiated, and those get codified in a contract between the investors and the company. And they're called negative covenants. An example of that would be, you covenant the company not to hire any employees unless they sign a proprietary information and invention assignment agreement. Or you, the company, promise not to grant options with a vesting schedule faster than 4 years. Those are the typical kind of negative covenants that you'll see in these early stage financings. A drag along, we are seeing this more and more, but the concept of a drag along is that if the big stockholders vote in favor of a major event, all the little stockholders get dragged along to vote as well. It's basically a voting agreement. And this is important from a legal standpoint because even though technically you may only need a majority of the stockholders to approve this major event, like a sale of the company, many acquirers want to see 98% of the stockholders support the sale. And by not having this kind of mechanism, you may empower a small stockholder to say no and act as a holdout and disrupt what the big stockholders want to do. And the last we talked about before, which is vesting of the team. It is of high interest for the investors coming in to know that the founders are going to stick around and are motivated to stick around. Investing is a great tool for doing that. The third bucket, information rights. In these early stages, information rights are probably not worth as much as you might think. Oftentimes, the company will covenant to provide periodic financial statements to the investors. Maybe it's monthly, quarterly, and annually. Maybe it's just annual. It could be, the operating results and the balance sheet. It could be an operating plan that then gets calibrated on a monthly basis. This is highly specific to a prospective investor, but I would say most companies end up providing their investors monthly and quarterly financials. Not detailed necessarily, but kind of summary. Not audited because it's too early to audit a company at this stage, but some information that gives the investors a perspective on how the money's actually being spent against what they may have promised they would spend it against. Inspection rights, those are statutory, but sometimes investors will ask for the right to come in and inspect the books and records, meet with management. And then if they don't have a board seat, they might come and ask for the right to at least observe a board meeting. And then last is the liquidity and resale. How do you get your money out of the company? Maybe on occasion the investors might negotiate a redemption clause. 5 years out, if I don't have liquidity, the company will redeem it from me. Registration rights are a very important, theoretically important, but practically speaking, unimportant right. In the U.S., if you're going to sell securities, you either have to have those securities be registered or you have to have an exemption from the sale. In these private transactions, we rely upon exemptions. It allows us to do them pretty quickly and inexpensively. But when a company gets big, they register their stock to go public and to create a public market. And if you're a stockholder in that company, and the company's already public, you actually don't get to just sell your stock. You have to still find an exemption from the registration, or you have to have it registered. And these rights theoretically force the company to register your stock. The reason why I say theoretically is because there is an exemption available, and it's a lot easier for everybody to just rely upon the exemption. But once in a while, we'll see that triggered. And then there's this new thing that emerged over the last decade called secondary selling. In the olden days, when I was all of your ages, there really was no concept of selling stock in a private company until the company had a liquidity event. But nowadays, there actually is a pretty robust secondary market for private securities in later stage private companies. And so we spent a bunch of time sort of working through that and helping make that happen without too much disruption to the underlying business. Sorry. The one last thing I'll point out on that slide is the cost and the timing. As I mentioned before, these seed fundings tend to take 2 to 4 weeks to close, and from a cost standpoint, if you're doing an equity round, they tend to be about $25,000 to $40,000, and on the debt side, they tend to be anywhere from $5,000 to $15,000. Yeah.
If you have a group like Google or Intel or one of these other corporate ventures who are funding you, at what point do they get to see all of your processes, because that's why they're funding you, but you don't want them to know everything that you're doing? How does that work here
Yeah.
for this?
Super interesting question. When you have a strategic investor coming in, how do you sort of open the kimono to them? And I think, I think you start with a non-disclosure agreement. Venture investors won't sign NDAs, but strategic investors usually will. But those are only as good as the money you throw behind enforcing them. And as a startup, you probably don't have any money. So it really is this delicate balance. It's like dating, The first date you might hold hands, the second date you might kiss, and the third date you might hug. And it's kind of the same thing. As they get more familiar with you and you get more confident that they're truly going to be an investor, you might open your kimono a little bit. A lot of the more sophisticated strategic investors have a pretty good delineation between those folks that are making the investment and managing the investment and those folks that are operational and doing product development. And they do, like Intel keeps a pretty good Chinese wall between those two resources. So it's a leap of faith. I mean, if you're going to bring them onto your cap table at some point, you're going to be very open with them. And you hope that they'll respect that. And along the way, as you're sort of finalizing this, you get the feeling that they're not going to be as respectful, you might not end up closing the deal with them.
Sort of a stupid question maybe, but.
No stupid questions.
Okay, then I want to ask. So where does that lead with the corporate investment? I mean, is the final goal that they just want to acquire what you're doing, or?
Good question. I think it's all over the map. I think if you talk to the folks at Comcast Ventures, they'll tell you that no, the goal is to sort of make money on their investment, and they're motivated to do that. If you talk to, the folks that have managed Procter & Gamble's investments, I think they'll tell you, yeah, this is a way that we frontier by making these investments. And if the companies are interesting to us, we'll place a bet. And if they become increasingly interesting to us, we'll buy them. And then the question is that good for the company? And are there things that you can do here to make it so that if they do want to buy, they're at least buying at a market price, not at a captive price. So these are the terms of an equity funding. When we're buying equity, all of these things tend to get defined in paper. And it's a lot of stuff, as you can see. Now, yes, we rely upon a lot of boilerplate, and we don't get too hefty about negotiating this. We kind of just use the standard template. And if anybody reads it, realize that they might not actually work as well as we think they do. But nevertheless, it's a lot of stuff, and the paper ends up being about this thick. Even when you use the Series C documents, it's a lot of paper, and it's a number of pieces of paper, a number of contracts. It's something that gets filed with the Secretary of State's office. There's security filings that need to be made. There's signatures that have to go back and forth. It's a real process, and it still has economic terms. These are important. The economic terms of the debt financing. And by the way, the debt financing, what the investors are doing is they're lending money to the company in exchange for a note. That's why it's called note financing at times. It's a promissory note. It's actually a convertible promissory note. It's the technical moniker. But the expectation is that note, that money, that is going to convert into equity in the next financing when all that other stuff gets defined. And so the things that matter to an investor in a debt financing versus what is it going to convert at? If I gave Airbnb a debt financing for their seed funding instead of what Coie did, which was an equity financing, their first round, and I just lent them the money and said, yeah, convert me in the next round. Well, their second round was roughly $1 billion valuation. So that would have been a bad move for me as the investor. I would have given the money in the early days when there was arguably very little value in the business. They would have used that money and they would have created $1 billion of value, and I wouldn't have shared any of that. So to avoid that from happening, investors in the debt financing usually put in place these two mechanisms. And usually what they're structured, the way they're structured is they'll say, my note, my principal and accrued interest will convert into the next equity financing at the lesser of a 20% discount to what the new investors are coming in at, or a $4.5 million valuation. And that way I'm locked into that $4.5 million valuation. Everybody follow that? So this tends to be the most important thing from an investor standpoint, and obviously from the company standpoint, it's like, well, what is the valuation? You know, am I comfortable with that? But I think it's fair to give investors their percentage, their pro rata piece of the appreciation that is created after you take in their money. The other thing, once in a while you'll see equity kickers. I'm not going to get too involved in that because in these seed debt deals, we really don't use these often. These are like warrants or extra shares of common stock. In the seed deals, we try to keep things super simple, so we really don't use these very often. Yeah.
What's the typical valuation cap?
Yeah, it's all over the map. And like I mentioned earlier, we took a look at our seed deals last year, and we ended up, it was 117 of them. And the valuations, the median was about, I think it was off the top of my head, 3.2 or 3.3. But there were certainly plenty that were above that.
But is that equity or is that?
That is the value of the enterprise before the money comes in. And so that's the valuation that the debt would convert into.
Is it higher this year or?
We don't have that. I'm sure that data's out there. I don't have it off the top of my head. I wouldn't be surprised if it's inching up. The market's been pretty hot for the last 2 years.
So back to the valuation. How do you determine that valuation? Is there appraisers out there, or do you get the average of 3? Or
Yeah, I mean there probably are appraisers. Nobody really does it at this stage. I think it's a negotiation. You know, the way it typically comes into play is either the investor has a strong opinion and he convinces the entrepreneur, or the entrepreneur has a strong opinion and he convinces the investor, or some third party like the lawyers or the advisory board will sort of say, hey, you know, this is kind of the... And oftentimes it's dictated not really by the value, but by how much percentage ownership the investors are expecting to get. So when you do a round for a couple $1 million at a seed stage, the investors are typically looking to own, as a group, 10 to 20%. And so if you raised $500,000, the valuation is probably going to be lower. If you raise $2 million, it's probably going to be higher. I mean, it's that unscientific. But that's generally how it works. And those are generally constituents that have some influence. You can look to the market and try to draw comparables. Oh, hey, Snapchat raised their first round at 37 3, so I should be there because I'm a photo sharing site. Well, the investors have to believe it or not believe it. So it's negotiated.
Defining success as an investment where you either get your money back or make money. What are you guys backing?
Well, I would tell you in this business, if you get your money back, that's not a success. I mean, I think the risk profile here is way too high to just get your money back. Because the risk is so high in this kind of investing, I think the expectation is that you get a better return than what you would get in the public equity markets by a long shot. It's just a higher risk. And then from a portfolio management standpoint, you know, you don't put all your eggs in this sort of high risk category, you kind of diversify. But you do put a portion in this high risk category because it has a higher beta going up and down. So, you know, the rule of thumb in venture, and this is venture, not seed, but I'll mimic it, is that about a third of the investments will go to zero. About a third of the investments will get 50 cents on the dollar to $1 on the dollar back. And the last third should be your profit. And hopefully in that last third you have some dramatic wins, you know, 100 X's.
so that second one, 50 to $1, that's you're losing money actually.
Yeah.
That's the exit plan. So of the third that's winning, what percentage of those are real winners?
I think it depends on the investor.
You have to take a while, throw out a wild number.
Ask Coie, they had a.
Yeah, it depends on the investor. I mean, I can point to some of the top funds, Greylock, Sequoia, Benchmark, that have probably a disproportionate number of really big hits in that third cabinet. Although they do have their other losses, but when they hit it big. So I don't know. I mean, it's really hard to say. And I think the reason it's, you know, the evidence that it's hard is you look at how many venture funds have gone out of business over the last decade and how many have survived. You know, there's a rule of thumb in venture that the top decile, you know, makes 90% of the money. And I think it's true. I haven't done the study myself, but
Top docile?
decile, top 10% of the money, make 90% of the money.
Kind of like real estate.
Yeah, probably. Other economic terms in these bridge deals, there's, you know, once in a very blue moon, the startup will be acquired before it raises its next round of capital. And so the investors will want, that provided that seed capital will expect a return. So you'll see oftentimes there'll be sort of an agreement that says, hey, if you get bought before we do the next round, before you convert it to equity, you either get to convert into equity at the valuation cap, or we'll just give you 2x your money back. You know, thank you for supporting us in these early days. And then once in a while, you'll also see these preemptive rights requested by the bigger seed investor. They want to be able to not only convert their note into the next round, but they want to participate in that next round and add a little bit more. So those are the economic terms. Usually there's not much from an information rights perspective that's codified in these seed bridge deals. It's sort of, hey, we'll wait till the notes convert into equity, and at which point this will get defined, but between now and then, I'm just hoping that you'll keep me in touch. Control, same thing. Very rarely is control negotiated in these seed bridge deals. And same with liquidity. I mean, it's a note, so theoretically, if the note, if the company doesn't convert, if the company doesn't raise another round, and it doesn't get acquired, the notes will come due at some point and have to be repaid. But a startup that hasn't been successful doesn't typically have any resources to repay a note. So it's kind of binary. Sort of like, hey, here's my money, and I hope it is the right resource you need to go and raise the next round. And if it's not, have a big boy. So you can see, so you can see the difference between kind of the number of things that get negotiated and finalized in a bridge debt deal or seed debt deal is dramatically less than what you see in an equity deal. And accordingly, the rule of thumb, at least from our group standpoint, is if you're raising a round of less than $1 million, try to have it structured as a debt deal. It'll be a lot faster, a lot less paperwork, a lot less legal expense. If you're raising more than that, you know, still try to do it cheap and easy. But if you can't, you know, it probably makes sense to have it be an equity deal. And the investors may predicate their investment on it being an equity deal. And that all being said, never stand on ceremony. It's more important to get the money into the company than to figure out how it's structured. That's at least my view. One last thing on structuring, you know, there is this thing that Y Combinator published called the SAFE, it's a popular mechanism right now for structuring seed investments. It's very similar to a convertible note in the sense that you give the company the money, and that money converts into the next round at whatever you've agreed it should convert at. These are just a quick comparison between seed notes and the Y Combinator SAFE. I'll just walk through it quickly. Technically, the seed notes are loans. Technically, the SAFEs are future advances against equity. There may or may not be a tax implication. You may actually start your long-term capital gains holding period by buying a SAFE, and arguably you may not be starting your long-term capital gains on the loan until that loan converts into equity. It's not entirely clear. Loans, by definition, have to have some interest. They have to have a minimum of interest. The minimum they can charge on interest is what's called the applicable federal rate. Right now it's sub 1%, so it's really nominal. A SAFE does not have to have an interest rate accruing. Notes do have to have a final due date. The SAFEs do not, unless they're negotiated, and they almost always are. But it's kind of silly even to have a due date because, again, I think these are binary investments. You're either investing with the expectation that it converts into the next round. If that round never happens, there's really not anything there to salvage, or there's rarely anything there. The upside is the same. Usually you do a cap and a discount. Exit premium is usually the same. It's usually, you know, either you convert at the cap valuation or you get paid 1 to 2 times your money. They convert into the next round. The notes are senior. Technically, debt is senior to equity. The SAFEs are not. They're on parity. So if there's ends up being that you just dissolve the company, there actually is something residual there. The investors get whatever's residual, and the SAFE holders do not. And then once in a while, there'll be something like a most favored nations clause or some information like that requested, but not very often. The costs are about the same to paper. Yeah.
So is the expectation of the investors the same for these different models of funding? I mean, is it inherently more expensive to do one than the other? Or?
It's a great question. Yes, I mean, I think if you're if you're an experienced investor at this stage of a company's life, which is the first money into the company, I think your expectations are binary, right? This is either gonna make it, at least make it to the next round, at which point other people's money will sort of bear the risk of funding it thereafter, or it won't. And if it doesn't, I'm not gonna get much money back into anything. And if it does, I still might not make money, but my ticket will still be valid for the lotto. And most investors get that. And most investors that are, again, professional, experienced seed investors, don't get overly worked up about the structure as long as you've sort of locked in this, the valuation. How much of this company's upside am I getting for my money is basically how they do it.
So this 10-20% number that you threw out is generally what a seed round.
It's about the dilution you see on a good, well done raise. You could sell more, like if it, depending on, right now that's the market. I could spin the clock back 3 years ago and it was more like a 20 to 30% of the company would be sold for your seed capital.
But that's the same whether it's debt or equity.
It really is. Okay. It's the same. So anyway, that was the end of my sort of planned talk. I hope it was helpful. I mean, we've talked a little bit about the sources of seed capital. We talked a little bit about starting that process and raising seed capital, and then I talked a little bit about the structure. More than happy to talk about other things offline or more formally if the group all wants to hear about it. But the bottom line is, raising capital is a chore. It's a tough thing to do. It's never easy. There are times when it's easier, and right now happens to be one of those times when it's easier to raise seed capital than it has been. But that doesn't mean it's easy. It requires a lot of work. It requires a lot of preparation. It's a team sport, which means you can't just do it on your own. You got to bring in other resources to help you. And it's an exercise of kissing a lot of frogs. Very rarely are you going to have a high batting average with your pitches. So be prepared for rejection. Don't take it personally, but do take it seriously. Meaning, infuse into your talk the criticism that you're getting. Some of it will be actually very valid. And it may be because you're not characterizing the opportunity the way you really should be characterizing it. Other times it may be just completely superfluous. But I wish you all luck. The few people that I did have a chance to talk to were doing some really interesting things. So this is a really high quality group. And I hope you guys are able to get to know one another. And if I can be of help, or my partners can be of help, we'd love to do so. So thank you.
We'll take a few questions.
Oh, sure.
Maybe any pressing questions. We'll take a few.
So this three different kind of financial mechanisms, what's the paper cost roughly?
So I would say that when you pay, what's the cost of doing this from a lawyer summary? So when you do an equity round, it can be, I think the midpoints are probably $25,000 to $40,000. Believe it or not, it's a lot of money. We've certainly done them cheaper. When there's no negotiation, everybody agrees upon the template. It's 10 or 15 grand, but there's a lot of paperwork there, and very rarely do investors not have opinions. And by the way, if you're raising money from a venture capitalist, oftentimes they will not only ask you to pay for your own legal fees, but they'll pay for their fees as well. And their fees are not exactly the same because they don't have to prepare the documents, but it's about 60 to 70% of what you're going to spend, they'll spend as well. On the debt side or the safe side, again, with no negotiation, we can close these things for 5 or 10 grand. With some negotiation, but not a sort of exorbitant amount, 15-ish grand. So it's about, it's about a third to half the cost to do these debt safe deals versus an equity deal. And by the way, when I talk about close, you got to understand pricing. From my standpoint, first, we're a big firm, but we're pretty honest about the pricing. It's everything. It's the securities filings. It's the stock certificates. It's managing. There's a lot of things. If I just isolated the deal itself, it's probably a little bit less. But you don't just do the deal. You got to have the securities filings. You got to have the tax filings. So anyway, that hopefully helps. Yeah.
You mentioned just now that it's getting easier. than before.
To raise seed capital?
Right. So did you mean from a process perspective, or did you mean from
Mm.
the ability to raise cap, and then what's the reason that you
Yeah.
think that process is?
Great question. I think it's, I think it is easier. I don't know if it's continuing to get easier, but it is easier now than it was a few years ago. And I think the reasons for that, first, there's a lot more angels willing to make investments. That statistic that I pointed to, where angel investing went from $1 to $2 billion to $20 billion over the last decade, shows that there's money available from angels at the seed stage. Part of that's because the venture guys are no longer doing as much at the seed, so there's this opportunity for angels to put that money in that they didn't otherwise have. I think we live in a unique area where people have made money and have an interest in giving back. They have friends that are starting companies, they have colleagues that are starting companies, and the opportunity to invest is readily available, and so they're making those investments. They have disposable income and they have access. There's also no better visibility online about where you can raise seed capital. There's Angel List, which is a great resource, a really truly amazing resource. There's other things as well. There's a lot of transparency that used to not exist. I mean, if I learn of a company, it doesn't take me very long to know who's behind that company, who's backed it, who the founders are. There's just so much information available. So I think all of that's driving the process. In terms of or driving the access. In terms of the process itself, because there's more people that are angel investing, I think that these things I just went through are better understood. And so, there are not a higher percentage of the deals that we're closing don't have much negotiation. They're like, hey, use those templates. We're all comfortable with them. We'll read them once, but if they're consistent with the templates that we've used in the past, we're not even going to comment on them. And that makes the process go a lot more quickly. And last, I would say, it's a lot less expensive to start a company, to build an MVP, to go to market than it used to be. So the companies that are raising seed capital are just more baked, they're further along than they used to be, and that makes it easier for an investor to get comfortable making the investment. Yeah.
Why do you think VCs have somewhat backed away from seed?
Yeah,
seed rounds?
great question. So the venture community, so a couple of different things. One is it's a smaller pool of capital than it used to be. It's obviously an uptick this past year, but historically from 2000, it's been on this downward trend until sort of the last couple of years. There's also fewer firms than there used to be. Again, last year's a little bit more of an anomaly where it's starting to grow a little bit, but as I mentioned, there's only 254 firms that raised that $28 billion. And if you sort of flip the clock back a decade, the number was more in the 450 range. And you have the dumbbell effect, where you had, a small group of that 254 raising the preponderance of that capital. So there's sort of less number of venture capitalists, and those that exist have bigger pools of capital. And when you're making an investment at the seed stage, it's really hard to put more than $1 million or $2 million at work. But if you're managing 1.7 billion, you can't your limitation is your time. How many companies can you actually invest in? 30? So if you have 1.7 billion and you're investing in 30 companies, you just do the math. It can't be at $1 million rate. The second thing is there's been this amazing ecosystem that's been sort of spinning these ideas into sort of MVPs and into companies. There's the Y Combinator that just finished their demo days. There's an assortment of other accelerators. There's the cost of starting a company, as I just mentioned, is really low. And so you're seeing a high volume of ideas going from ideation into sort of market testing. And there's a bunch of investors that are seeding it, and they only need $300,000-$500,000 to do it. So as a venture guy, I don't have to play in that market to sort of have the ecosystem available to me. Somebody else is creating that ecosystem, and so I can sit back a little later and wait for them to nurture up and figure out which is the biggest fish in the pot to sort of throw my spear at. So I think those are the trends. Will they stay that way? I don't know. I think that the venture returns have been phenomenal, and I think that's driving more money into venture. But if you also look at where the money's been made in venture, you could argue that a lot of it's been momentum based. Don't invest until you see Snapchat at over 10 million active daily users and then pile in.